We offer redeemable preference shares. That allows an investor to come into our company and to fund our lending businesses of Finance One Consumer and Finance One Commercial loans, along with our debt collection companies now of Strategic Collections and Commercial Credit Control. This is 25 years of lending and collecting money experience has gone into this business model. 13 years now since inception, from when we first borrowed money from our investors. And we've never missed a beat to our investors for an interest payment or a redemption when they've come to maturity. We offer a high yield, reliable monthly return to our investors from 4.25 to 9% per annum. This gives our investors an opportunity to invest in a fixed income and a fixed return investment. Transparency has been the key to our success, with our investors fully understanding the business model that they're investing into. It's been a big year for us at Finance One. We did 27,400 applications processed for the year. So that was a record amount. That's a lot of loans that we processed. We settled, though, only out of those, 7,680. But we settled $192 million in loans. It gives me great pleasure to talk about some of the highlights from our financial year that Darren Tam has encouraged you to read through the annual report. Our total revenue was up 34% from $56 million to over $76 million. Net profit before tax was up 53% from $8.3 million to $12.7 million. Net profit after tax was up 50%. From $5.8 million to $8.8 million. And total equity, it has grown 27%, from $28.7 million to over $36 million in equity. Cash holdings as at the 30th of June were $58 million. Our loan book, it's increased from $230 million to over $321 million. That was an increase of 34%. Now that's pre-provision, so we take the provision for doubtful debts off that. Now, if we looked at that, though, that's quite a significant growth over the last 12 months. To put it in perspective, though, we did pause. We completely stopped our lending during COVID. Then we slowly started back, and that's why we're seeing that gap again. So you can see the discipline that we showed during COVID to stop lending. So at any time, we're not a company that's listed on the stock market. The share price is not our driver. Longevity in this industry sector and meeting our obligations is the driver. Through that, you can see that we plateaued, and then we reassessed, and then we went again. A recession is not the end of the world. A recession is a tightening of people's belts. A recession for us means that we need to manage clients' expectations through those events. We've paid over $27.8 million in interest to our investors last financial year. And as I mentioned before, we've paid over $133 million to our investors since 2010. I'm very, very proud of that. And the gap continues to grow between the size of our loan book and funds borrowed from investors through the reinvestment of profits on a monthly basis, and we continue to do that. This year, we'll be reinvesting over 75% of the net profits after tax back into the company. Risk management, it's a vital part of our business, and we manage this very carefully. As our loan book matures and grows, we budgeted last financial year on 17 to 19% of revenue to be written off. So, and Quinn alluded to that, is we've come down from 14% of revenue to just over 12% of revenue for our combined provision for doubtful debts and write-off. Moving forward, though, again, moving into an unusual inflationary event, we're still going to budget on that 17 to 19% moving forward. We've also got a provision for doubtful debts of over $15 million. We believe that's a cautious view of how we manage our loan book. Additionally to that, we look at our write-off tolerance levels each year. This helps demonstrate the strengths of our business model. So the next graph shows what we're owed in principal and interest from our customers over the next 6 years to what we're owed back to our investors after cash holdings are returned to them. So we're looking at a difference of $476 million to $265 million. So that's a difference of over $211 million from what we're owed by our customers to what we owe our investors in principal. If we take off our historical provision for doubtful debts of 3.2%, this still leaves us with a balance of $460 million. If we had to stress test the business model and we take off a write-off of 7%, we would still be left with $443 million, or if we extrapolate that to a full 25%, we're still owed over $350 million. We continue to build a substantial margin of safety back into the business model.